Welcome to a definitive masterclass on the most dangerous psychological trap in finance. I'm Todd Uzzell. Over the next 15 minutes, we are dissecting the nominal illusion, the phenomenon that blinds even the most seasoned investors to a currency collapse. When your portfolio is hitting record highs, but your purchasing power is hitting record lows, you aren't getting rich, you're being liquidated in real time. This is the heart of the illusion, and today we're breaking the spell. To understand the illusion, we must look at the foundation of our global system. We start in 1944 at a hotel in New Hampshire called Bretton Woods. This was the moment the US dollar became the world's anchor. 44 nations agreed that the US dollar would be the world's reserve currency. It was pegged directly to gold at $35 an ounce. This made the dollar as good as gold for global trade and central bank reserves. But this created a paradox known as the Triffin dilemma. To provide the world with liquidity, the US had to run deficits. But those very deficits undermined the world's confidence in the dollar's gold backing. By the late 60s, French President Charles de Gaulle famously challenged the system, demanding France's dollar reserves be converted back to physical gold. The world realized the US was printing more dollars than it had gold to back. Before the system collapsed, major central banks tried to save it through the London Gold Pool. They collectively sold gold to keep the market price at $35. But the market's hunger for gold was greater than their supply. In March 1968, the London Gold Pool collapsed. The market was now pricing gold higher than the official rate. The nominal and the real were beginning their violent decoupling. This was the first major cracks in the foundation. On August 15, 1971, President Nixon unilaterally suspended the dollar's convertibility. This wasn't just a policy shift, it was the birth of the modern fiat era. The nominal illusion was officially codified into our monetary system. To save the dollar's status, the US struck a deal with Saudi Arabia. Oil would be priced exclusively in dollars. This created a permanent global demand for the greenback, even without the gold backing. It was a brilliant but temporary fix. Let's examine the most haunting case study in history, the Weimar Republic from 1921 to 1923. This is hyperinflation in its purest, most destructive form, the era of billionaires. Germany was crushed by war reparations. To pay, they printed. In 1914, 4 marks bought a dollar. By 1923, it took 4.2 trillion marks. The currency was literally worth less than the paper it was printed on. We saw Gresham's law in action. People spent their rapidly devaluing marks immediately and hoarded anything of real value, gold, silver, even household tools. The bad money was forced into the market, while the good money disappeared. One man, Hugo Stinnes, realized the illusion. He borrowed massive amounts of marks to buy hard industrial assets. By the time the loans were due, he could pay them back with worthless paper, effectively getting the factories for free. This is the master playbook. But while Stinnes grew rich, the middle class was wiped out. Those who had spent their lives saving for retirement found that their life's work couldn't buy a single egg. This is why the nominal illusion is so socially corrosive. Think this is a relic of the past? Look at Venezuela. Since 2013, the bolivar has been devalued by over 99%. It is the ultimate modern example of digital wealth being erased in real time. The government has repeatedly redenominated the currency, removing 14 zeros in just over a decade. When currency becomes an art supply instead of a store of value, the nominal numbers on a stock ticker are a dangerous distraction. This is the zero game. It's a psychological tool used by governments to mask the scale of the collapse. By resetting the currency, they trick the population into thinking the problem is solved, while the underlying debt remains. It's a digital sleight of hand. Argentina's 2001 crisis shows us how fast a safe peg can break. For a decade, the peso was 1-to-1 with the dollar. Then, the system snapped. Savings were frozen in the corralito, and the illusion of safety vanished in a week. It was a brutal wake-up call. Then there is Zimbabwe. At the height of their hyperinflation, the central bank issued a $100 trillion note. It wouldn't even buy a bus ticket. This is the ultimate endpoint of the nominal illusion, mathematical absurdity. During this time, the Zimbabwe stock market was the best performing in the world in local currency terms. Indices hit quadrillions. But in real terms, it was a graveyard for capital. You cannot eat stock certificates when the system is broken. Now, let's address the biggest confusion for investors. Why do stock markets often hit record highs during a currency collapse? This is the core of the nominal illusion. It's not growth, it's flight. In a collapse, the stock market doesn't rise because of growth. It rises because investors are desperately fleeing a rotting currency. They'd rather hold a share in a factory, a physical thing, than a stack of dying paper. It's an asset-driven life raft. Our brains aren't wired for logarithmic devaluation. We see our portfolio up 50% and feel wealthy. But if the cost of living doubled in the same period, we've actually lost 25% of our wealth. That is the trap. It's a numerical siren song. We must also discuss the Cantillon effect. When new money is printed, it doesn't enter the economy all at once. It flows first to the financial institutions and the wealthy, who can buy assets before prices rise. By the time it reaches you, the purchasing power is already gone. So how do you protect yourself? If we are entering a period of global monetary transition, you need to stop measuring your wealth in unbacked paper. You need a new denominator. You need a baseline of truth. Step 1. Measure your performance in gold or a basket of hard commodities. When you remove the currency distortion, the real picture of your wealth emerges. This is the only way to see through the nominal illusion. It's the ultimate financial filter. Step 2. Focus on assets with intrinsic utility. Real estate, productive farmland, energy infrastructure, and companies with pricing power, those that can raise prices to match inflation without losing customers. These assets have a floor value that unbacked paper does not. Construction matters. A resilient portfolio during a currency transition isn't about gambling, it's about insurance. You are diversifying out of the system that is failing and into the assets that underpin the physical world. It's a defensive posture that allows for offensive opportunities. Productive land is one of the few assets that can't be printed, devalued, or digitally erased. It provides a baseline of human necessity, food and shelter. In every currency collapse in history, farmland has remained a cornerstone of real wealth preservation. Think of energy as a currency. In a hyperinflationary environment, the cost of energy rises first. By owning energy producers or infrastructure, you are effectively owning the fuel of the economy. This is a natural hedge against devaluation. Gold and silver are the world's only Tier 1 assets with no counterparty risk. They have been money for 5,000 years. When the nominal illusion breaks, the world returns to the only thing that has never failed: physical precious metals. Before we wrap, here is your 15-minute checklist. 1. Denominate your portfolio in gold. 2. Audit your exposure to unbacked debt. 3. Increase your allocation to productive real assets. And 4. Maintain liquidity in multiple jurisdictions. The hardest part of surviving the nominal illusion isn't the technical side, it's the psychological side. You must have the discipline to trust the math over the headlines. Don't be fooled by nominal gains while you're experiencing real losses. The nominal illusion only works on those who aren't looking. Now that you've seen the history and the technical reality, you know the signs. You have the playbook. Now, you must have the discipline to follow it. This is how you protect your family's future. Stay vigilant, stay anchored in reality, and let's start the conversation in the comments below. I'm Todd Uzzell. I'll see you in the next masterclass. Knowledge is the only asset that can't be devalued. Many people compare our current situation to the 1970s, but there's a key difference: the scale of global debt. In the 70s, we had a debt-to-GDP ratio that allowed for high interest rates. Today, that math is much more precarious. When debt levels are this high, central banks are trapped. Raising rates to fight inflation threatens to bankrupt the government itself. This is why the nominal illusion is being pushed to its absolute limits in the modern era. We are also witnessing a transition in global reserve status. The rise of the BRICS nations and the search for dollar alternatives is accelerating. This is a historic shift that happens once every 80 to 100 years. If a new trade currency backed by commodities emerges, the demand for unbacked dollars will shift drastically. This is the moment when the nominal illusion finally meets the reality of the physical world. Are you prepared for that day? We must also consider the role of decentralized digital assets. While volatile, they offer a way to move value outside of the traditional banking system. For some, they represent a modern, digital version of gold for the 21st century. The key advantage is the lack of a central authority that can print the asset into oblivion. In a world of infinite paper, finite digital assets offer a unique hedge, if you understand the risks. Diversification is still the name of the game. Regardless of the asset, self-custody is the final piece of the protection playbook. If you don't own it directly, you only own a claim on it. In a systemic collapse, a claim is just another piece of paper. True ownership is the only safety. Finally, consider jurisdictional diversification. Holding all your assets in one legal system makes you vulnerable to that system's failures. Spreading your wealth across different geographies and legal frameworks adds another layer of security to your plan. We've covered a lot today, from the history of Bretton Woods to the technical strategies of the modern era. The most important thing you can do now is take action. Review your portfolio, audit your debt, and stay anchored in real value. I'm Todd Uzzell. Thank you for joining me for this 15-minute masterclass. Let's keep the conversation going in the comments. I'll see you in the next one. Take care. To truly understand hyperinflation, we have to realize it's not a modern invention. From ancient Rome's debasement of the denarius to the assignat of the French Revolution, the pattern is always the same. Overspending followed by currency destruction. The Romans slowly reduced the silver content of their coins to pay for their vast empire. By the end, the silver coins were just silver-washed copper. The resulting inflation was one of the key factors in the empire's decline. The lesson? Math is immutable. During the French Revolution, the government issued assignats backed by confiscated church lands, but they printed so many that the land backing became meaningless. The currency collapsed, leading to widespread chaos. This is the nominal illusion on a grand historic scale. The 20th century was a laboratory for fiat experimentation. We saw more currency collapses in 100 years than in the previous 1,000. Each time, the nominal illusion was the tool used to pacify the population until the final snap. Beyond the numbers, hyperinflation is a social tragedy. It destroys trust. It destroys the incentive to work and save. It breaks the social contract between the citizen and the state. This is why preserving your wealth is also about preserving your family's stability. In times of collapse, community and real-world skills become their own form of currency. Networking with like-minded individuals and developing practical expertise is just as important as your asset allocation. Don't neglect the human element of your protection plan. In our increasingly digital world, tangible assets offer a grounding force. Whether it's a physical business, a piece of equipment, or a stockpile of necessities, owning things you can see and touch provides a psychological buffer against the nominal illusion. Even fine art and collectibles can serve as hedges. Like gold, they are finite and have a historical record of value preservation. While more niche, they offer another way to move value out of a dying currency and into something with cultural or aesthetic intrinsic worth. Survival requires taking the long view. A currency collapse is a multi-year, sometimes multi-decade process. You don't need to panic, but you do need to be prepared. Consistency in your strategy is more important than timing the exact bottom. I'm Todd Uzzell. This masterclass is just the beginning. Knowledge is your greatest asset. Use it wisely, stay vigilant, and I'll see you in the next deep dive. Take care of yourselves and your futures. When the illusion breaks, fear takes over. But fear is a poor advisor. You must lean on the math. The technical signals of currency devaluation are clear if you know where to look. Trust your research, not your emotions. History is full of stories of families who not only survived but thrived during currency transitions. They were the ones who saw through the nominal gains and positioned themselves in real assets early. You can be part of that story. Responsibility is the key. Protecting your wealth is about more than just your own retirement. It's about building a multi-generational plan. This requires a shift in mindset from short-term gains to long-term stability. The nominal illusion is the greatest enemy of that legacy. The most important asset you can pass down isn't money. It's the knowledge of how money works. Teach your children about the nominal illusion. Teach them how to value assets in hard terms. That is the ultimate inheritance. It's the only thing that lasts. We see Gresham's law in the modern world too. Look at the record demand for gold and silver from central banks today. They are trading their unbacked paper for the only thing they trust. They are leading the way. Are you following their lead? In the last few years, central bank gold buying has hit multi-decade highs. These are the institutions that print the currency, yet they are the ones fleeing it. This is a massive signal that the nominal illusion is reaching its final chapters. Pay attention. To wrap up this 15-minute masterclass, remember, the nominal illusion is a trap for the distracted. Stay focused on the real math. Auditing your assets, diversifying your risk, and staying anchored in utility is the only path forward. I'm Todd Uzzell. Thank you for your time and your attention. It's the most valuable thing you have. I'll see you in the next masterclass. Knowledge is the foundation of freedom. Stay safe out there. Could we see a return to some form of gold standard? Some believe a new digital system backed by hard assets is the only way out of the global debt trap. While uncertain, the move toward hard assets is already happening. The trend is your friend. The numbers may change, but the principles of value are eternal. I'll see you in the next one. Take care.